For this video, we are going to tackle Chapter 28, which is the SMEs or Small Medium Enterprises Liabilities. In this chapter, we have four parts. We have provisions and contingencies, leases, employee benefits, and for this video, our focus is income tax. Before we go further in this lesson, first we need to know what income tax is. The PFRS for SMEs provides that income tax includes all domestic and foreign taxes that are based on taxable profit. Income tax includes taxes such as withholding taxes, payable by a subsidiary, associate, or joint venture as distributions to the reporting entity. Next is what current tax asset or liability. An SME shall recognize a current tax liability for taxable profit for the current and past periods. If the amount already paid for the current and prior periods exceeds the amount of payable for those periods, the excess is recognized as a current tax asset. Remember that a current tax asset is a prepaid income tax. For the measurement of current tax asset or liability, current tax asset and liability and related tax expense are measured at the amount expected to be paid or recovered, using the tax rate that has been enacted or substantively enacted at the reporting date. Next, what is deferred tax liability? A deferred tax liability is the amount of income tax payable in future periods with respect to a taxable temporary difference. A deferred tax liability is the deferred tax consequence of a future taxable amount. Also, a deferred tax liability is presented as a non-current liability. Next, what is deferred tax asset? A deferred tax asset is the amount of income tax recoverable in future periods with respect to a deductible temporary difference. A deferred tax asset is the deferred tax consequence of a future deductible amount and operating loss carry forward. Also, a deferred tax asset is presented as a non-current asset. For the temporary differences are differences between the carrying amount of an asset or liability and the tax basis. The temporary difference that will result to future taxable amount are known as taxable differences, and the temporary differences that will result to future deductible amount are known as deductible temporary differences. Recognition of deferred asset or liability. To recognize either deferred asset or liability, it shall meet all the following. First, a deferred tax liability shall be recognized for all temporary differences that are expected to increase taxable profit in the future. Second is, a deferred tax asset shall be recognized for all temporary differences that are expected to reduce taxable profit in the future. Third one is, a deferred tax asset shall be recognized for the carryover of net operating loss. And the last one, a deferred tax asset shall be recognized to the extent that is probable that taxable income will be available against which the deductible temporary difference can be utilized. For the measurement of deferred tax asset or liability, deferred tax asset and liability is measured using the tax rate that has been enacted by the end of the reporting period and expected to apply in the period when the asset is recovered or the liability is settled. The future enacted tax rate is used in measuring a deferred tax asset or deferred tax liability. Remember that deferred tax asset and deferred tax liability are not discounted. For the allocation of tax expense, an entity shall recognize tax expense in the same component of total comprehensive income or equity as the transaction or other event that resulted in the tax expense. For example, the presentation should be income from continuing operations net of tax, income from discontinued operations net of tax, and other comprehensive income net of tax. This is known as intra-period tax allocation. Intra-period tax allocation means that the income tax should be deducted from the related income that brought about tax. And this is what we call inter-period tax allocation. Next is offsetting. An SME shall offset current tax asset and current tax liability, or offset deferred tax asset and deferred tax liability when all of the following conditions are present. First is when the entity has a legally enforceable right to set off the amounts. Next is when the entity intends either to settle on a net basis or to realize the asset and settle the liability simultaneously. Last one is the comparison with full PFRS. The full PFRS and amended PFRS for SMEs are now the same in the matter of accounting.